Welcome to Module 11 in our financial accounting course. This module is all about the cash flow statement. Now, we've already introduced three other statements, the income statement, the statement of retained earnings, and the balance sheet, and we add the fourth key financial statement, the cash flow statement. So you've likely heard this phrase before, cash is king. And it's true, and it's true for a multitude of reasons, but isn't it interesting, right? We have all kinds of assets. We have accounts receivable, inventory, we have all kinds of equipment. Cash is the only asset that gets its own financial statement dedicated to it, and it's because cash is king, and that means cash is super important. Now, it's important for many reasons. I'm going to introduce two reasons why a cash flow statement is needed. And the first is, if a company runs out of cash, it's dead. It is over. If you don't have money, you can no longer pay your bills, and therefore your suppliers will stop supplying you, and you can no longer pay your employees, and your employees will stop coming to work. The company is dead if it runs out of cash. So it's a very, very important asset. So if you're a shareholder, you're interested in a company, you are very interested that they don't run out of cash. And isn't that reason enough to have a whole financial statement devoted to cash? But there's another reason as well. And you might not know this if you're in an intro class, but accountants are not just accountants. They're often magicians. Certainly the best and most highly paid ones are magicians. And what do I mean? Well, there's a joke in accounting, and it's not the funniest joke in the world. Us accountants aren't the funniest people, but I'm going to tell you the joke. You're hiring your new accountant. You ask that accountant, what's 1 + 1? If the accountant says 2, you don't give him the job. The correct answer to what's 1 + 1 is whatever number you want it to be. You want your profits a little higher? A good accountant can make your profits a little higher. You want to show less profit and pay less tax. A good accountant will show you all sorts of tricks and techniques to avoid taxes. Financial statements can be maneuvered by good accountants. A good accountant is like a magician. Well, finance people, if you're a financial statement user, this is actually bothersome for you because you go, do I trust the financial statement, or is the accountant actually being a magician and playing a trick on me? And so there's one account that really is exempt from a lot of these tricks. If I want to overstate my equipment or change my receivables balance, I can change estimates, right? I can change my estimate for depreciation expense to change the equipment balances. I can change my estimate for the allowance for doubtful accounts, and that changes the receivables balance. One thing even a great accountant will have a hard time maneuvering is cash. Now, there's cash management, there are cash flow decisions, but cash is a very real number. Ask me how much my car is worth. Is it worth $10,000 or $12,000? I really don't know. It's an estimate, right? What is my used truck? It's a truck. What is it really worth? Somewhere between $10,000 and $12,000, I guess. How much is my checking account worth? I can tell you to the penny, right? It's a real, true number. And because of it, finance people, financial statement users are very obsessed with cash. When you go on in your coursework, you might take a finance class and you'll see all they talk about in finance is cash flow. They're interested in cash flow, and because they're interested in cash flow, it's the job of the accounting function to provide them with good cash flow information. So you may be saying to yourself, good cash flow information. I remember chapter 2. We learned how to do journal entries. And in chapter 2, I know how to make a cash T account. Why don't I just give them this, right? And just slap a label on top of my cash T account and call it cash flow. Oh, my writing is beautiful. Statement, right? Why don't I just slap a label on top of a cash T account and call it a cash flow statement? And the answer is, well, there's a couple of reasons why we can't and don't do this. Because, you know how to prepare a cash T account already. Why can't I do this? If you've ever worked for a real company, it becomes very obvious very quickly. I'm imagining Walmart in my hometown here of Kamloops. It's not a particularly big city. It's not a particularly big Walmart. I imagine if I looked at their cash T account this morning, it's before noon right now. I imagine if I looked at their cash T account this morning, it would not look like this. Walmart's cash T account in my hometown for one morning would look like this. And in fact, it would just keep going and going and going and going, right? It continues on and on. So, and that's for half a day, let alone a year. It would just be pages and pages and pages and pages. And even for, it doesn't have to be a big, massive company like Walmart. Small companies have a lot of cash transactions. It would take pages and pages and pages. And so you have to summarize it in an organized and logical way. So organizing this makes this volume of information useful. And that's what the cash flow statement is for. It's saying, taking all these cash transactions, summarizing them, organizing them. I just smashed my hand into my monitor, and making them useful. So we organize it into 3 sections. The first section is the operating section. So we say any operating cash flows go here. And operating cash flows you can think of as the day-to-day business. So talking of Walmart, what are their operating cash flows? It's selling stuff to their customers, generates positive cash flow for them, paying their bills to their suppliers, right? People ship them inventory. They got to pay for that inventory. That's a big outflow, paying employees' salaries, and just paying the day-to-day bills of running a business. Those are the typical operating cash flows of a Walmart. Now, I summarize that into most transactions that make up net income, so revenues and expenses, as well as most transactions that transact in current assets and current liabilities, paying off your accounts payable, collecting on your accounts receivable. Those are the key accounts involved in operating activities. In investing activities, so we want to split those off, right? The day-to-day, so Walmart selling stuff to our customers, paying our employees, paying our suppliers, paying taxes is also considered an operating activity. And there's a few others, but those are like the key activities. And we're just saying what's cash in, cash out from doing this, right? And hopefully you're generating a lot of cash from your day-to-day business. It should be a positive number and hopefully a big one. Investing activities are all about long-term assets. So when Walmart in my hometown, they just did a huge renovation, cost them multiple millions of dollars. Well, that renovation isn't part of the day-to-day business, right? The fact that they added a whole like grocery store wing to the store that didn't exist previously, that is an investing activity. They bought a ton of long-term assets. They renovated the place. That is an investing cash flow. So anytime a company's buying and selling equipment, buildings, things like this, it's an investing activity. And companies buying and selling other companies, if you get to that size, right? When Facebook bought Instagram, I think for $1 billion, years and years ago. I guess they're all called Meta now. But anyway, Facebook owns Instagram and it was $1 billion. Well, that was an investing activity. They paid $1 billion to buy Instagram. Financing activities, all about long-term liabilities, debt, and shareholders' equity. So the company issues new shares, it's a financing activity, or they buy back their own shares, that's a financing activity. They borrow money from the bank or they repay their loan, that's a financing activity. And last, with shareholders' equity, dividends, if they pay dividends, that is also considered a financing activity. So those are the 3 major sections. We're going to learn this chapter to summarize our cash flows into those categories. One last point in this video, and then we'll say goodbye. I put a little star by operating, and that star is, when it comes to investing and financing, there's only one way to do it, and we'll learn that one way. When it comes to the operating cash flow, there's 2 ways to prepare them: the direct method and the indirect method. In our class, we're going to learn both. I'll just give a high-level summary here. The direct method says, where do your cash come from and where do you spend it as it relates to employee salaries, as it relates to collecting from customers, that type of thing. Most academics like me prefer the direct method, so I will teach it in the course. But if you only have to learn one or the other, it's easy enough to skip around in the videos. The indirect method says, no, start with net income and work backwards. That's why they call it indirect. It's kind of backwards working. So it sort of says net income's almost like our operating cash flow. Revenues and expenses are mostly operating items. Why don't we start there and just work backwards? So we're going to learn both the direct and indirect method this chapter, but if you if your course is focusing on one or the other, you can focus on one or the other. If you're my student, lucky you, you're going to be responsible to learn both methods. But the best way to learn anything in accounting is to do examples. So please go on to the next video. We'll work through a comprehensive example of a cash flow statement. I can't wait to get started. I'm so glad you're here, and I'll see you in the next video. Goodbye. The next video in our series is right up here, and if you want a supercut of all of the videos in this series, that's the one down below.